Strategies that help you keep more of your money rather than pay taxes. Join me, Erik Brenner, right now on Your Wealth Health. Good morning, everyone. Welcome to Your Wealth Health. I'm Erik Brenner, owner of Hilltop Wealth Solutions. Thanks for joining me today. With me today, I have Bill Davis, and we are still practicing social distancing. He is in the studio to my right, and so we're going to talk about a very important topic today, and that is taxes. What I first want you to do, if you're watching us on Facebook, I'd like you to like us, share us. If you're watching us online, thank you for that. And let's dive right into taxes. You know, Bill, we talk about if you can't spend it, if you don't keep it. That's a phrase that we talk about a lot, and we think it's an important phrase.
Yeah, Erik, this topic's a really important one in that I don't think that people think too deeply about a strategy to have their retirement plan be the most tax efficient. And so what we'd like people to do is think about it much earlier than retirement. And we'll talk about, kind of the sweet spot between the ages of maybe 60 and 72. But even earlier than that, people should get a better understanding of what their tax situation is, how to minimize their taxes during their accumulation phase, but also diversify their buckets of retirement savings so that we go into retirement with a more tax-efficient strategy.
Yeah, Bill, and I think it's really important as we move into the show that we separate and think about tax preparation versus tax planning. So we want to consider some things for tax planning. We're not talking about tax preparation. Tax preparation is it's the end of the year. You take all your stuff to your accountant or CPA, tax preparer. They prepare your taxes, they tell you whether you owe or you get a refund. We're talking about tax planning. And so let's talk about some of the considerations as it relates to how people should think about it, Bill.
Yeah, so you need to be thinking about, these buckets of money is the best way to understand it. And you're going to have, pre-tax savings. That's going to save you money today. You're going to have after-tax savings, and that could be accumulated in Roth IRAs is a pretty attractive strategy, non-qualified investment buckets that you might have the ability to pay lower taxes on interest, dividends, and capital gains. And so really understanding during the accumulation phase that you're going to save in multiple buckets, not just in your retirement plan.
So, Bill, a lot of people think that they'll be in a lower tax bracket when they retire. Therefore, it's put money in pre-tax, save that money as your pre-tax as you're working, and then when you get to retirement, you're in a lower tax bracket. And so sometimes that's true, but we also find sometimes that may not be the case.
Well, yeah, I don't think most people want to have a lower lifestyle in retirement. And many times they don't grasp the fact that their Social Security might be taxable, and they're going. There's just multiple layers of issues that relate to the taxability that are not commonly discussed with the tax preparer. We don't underestimate the importance of our CPAs, professionals, and their tax preparation, but they just don't have the time oftentimes to help our clients sit down and really analyze their tax return to better understand things like effective tax rates and managing income up to certain income limits and things like that.
So right now, Bill, we want to make sure that people are taking advantage of a tax strategy. And the second thing is taking advantage of low tax rates. The government right now is spending a lot of money, isn't it? And we think probably taxes are going to go up, but they're spending a lot of money right now.
Well, Eric, in June alone, we added over $860 billion to the federal deficit. So our federal deficit is currently approaching $24 trillion. I don't care what politics you want to look at, what side of the aisle you discuss, we're going to have to be thinking about tax increases, and I think that's being discussed on both sides of the aisle right now, because we just can't, we're not going to be able to find ways to cut from the budget. We're going to have to fix the revenue side, which is going to be taxes. And under our current tax code, we think that we have a limited amount of time for people to take advantage of some of these lower tax brackets. And especially thinking about August 31st, we have an extension to return required minimum distributions. And I had a client this week, when we looked at his tax return, just the fact that, you know, he won't have to take a required minimum distribution of about $25,000 this year. It was going to be a significant tax savings once to plan the amount of IRA distribution we want to take out versus the required minimum amount. So now's the time to act, and to, especially if you're over the age of required minimum distribution, to consider returning your required minimum distribution that you may have taken out in the prior part of the year, or how much of your IRA distribution should you take out to stay in the lowest tax bracket.
So let's ask you out there, the viewers, do you think taxes are going to go up, go down, or stay the same? When we ask that question to our clients as we work with people each day, almost everybody thinks they're going to go up. In fact, I don't know, I think my clients, Bill, it's everybody, think they're going to go up. And so putting together and having a tax strategy can be really, really important. And unfortunately, a lot of advisors overlook that. So let's just talk briefly, Bill. Okay, what is a tax strategy? Does that mean when you're saving taxes, does that mean just throwing it in a Roth IRA or some of it in a Roth IRA? What does that really mean?
Well, what it really means is it depends. You know, every person's situation is different, and every person's situation can change year to year depending on circumstances and amount of distributions and things like that. So, you know, it really does depend. It involves getting your tax return out. It's probably is a great time right now because you may have just filed your tax return. Sitting down with a professional, breaking it down. What categories of your income stream was taxable at what rates? And it's just very enlightening, especially when you get to that line that says, I had $30,000 of Social Security, how much of that was taxed? And again, up to 85% is the amount that can flow over to ordinary income, to taxable income. And so you can look at how to possibly reduce other sources of income to get that down to either not being taxable or somewhere between 15 and 85%.
And so as you get into retirement, Bill, we really see taxes and healthcare as the two biggest expenses people will spend money on.
Yes, absolutely. I think that the way our Medicare and Medicare supplement systems are set up, it would make sense that taxes themselves would be the largest expense for people in retirement. But guess what? It doesn't have to be with appropriate planning. And a retirement income strategy is the key, so that you're pulling money from multiple places. That goes without saying that during your accumulation phase, you would have had to plan what the buckets that you're going to fill during the accumulation phase prior to your retirement age.
So does your advisor have the right answers to the questions for your tax strategy? When we return, we're going to talk about some of the questions you should ask your advisor to make sure they're working in your best interest. Stay with us.
Soapy Sam's Car Wash, corner of State Road 23 and Fur Road in Granger.
We, the people of the United States, in order to form a more perfect union, establish justice, ensure domestic tranquility, provide for the common defense, promote the general welfare, and secure the blessings of liberty to ourselves and our posterity.
We, the people, are all our heroes, and Perry Automotive knows that. Now until the end of the year, we're extending our local heroes discount to the people, because you are all heroes.
Welcome back to Your Wealth Health. I'm Erik Brenner. Thanks for joining me today. In the studio and practicing social distancing is Bill Davis, one of our private wealth advisors. If you're watching us online, I want to thank you for that. And if you're watching us on Facebook and you think this is an interesting topic that someone may get value out of, please hit the share button. We would appreciate that. So we're talking about taxes today, and one of the things that we think is important when it comes to taxes is the advice that you are getting on taxes. And what we're talking about is not tax preparation. We're talking about tax planning. And we at Hilltop are fiduciary financial advisors. And what that means is that we must always act in the best interest of our clients. We only succeed if our clients succeed. And so we never try to sell products. We're really consultative based, and we think that is really important. And one of the things, Bill, we think is important is education. So I know as a firm, we belong to a handful of organizations that help our educational process, including some experts in this exact field.
Yeah, you know, the four of us in the firm have been doing this for over 100 years. So, I mean, we have the experience, but we feel strongly in sharpening the saw. And so I think the number within the firm is in excess of $50,000 per year in educational conferences, monthly trainings, the Elite Advisor Group that's been emphasized on this show in the last couple of weeks with Ed Slott. So the Savvy Social Security. So, you know, being educated to give broad-based advice that touches in many different areas, from taxes to investments to risk management to estate planning. There's just a lot as the laws move rapidly, the tax code changes often, and we just need to continue to sharpen the saw to be able to keep up on those changes, Erik.
Yeah, and I think, you know, in our industry, I mean, there's obviously a lot of training and conferences and now webinars that we can attend throughout the week, just like in many professions. And it really, the way I think about it is it separates into a couple buckets. The first bucket is about sales, and it really leads to selling and products and solutions. And we certainly can sit on a lot of those, and we choose not to for the most part because it really is driven around sales of a product. The second bucket would be more about education and strategies. And so Bill mentioned Ed Slott. You know, the Ed Slott program and the Elite Advisor program, you know, Ed is one of the country's leading experts in IRA planning. He has a team of tax attorneys and CPAs that are there for us to utilize on cases so we can get second opinions. And his Elite Advisor program is about 400 advisors around the country. Now that 400 is important because there's about 300,000 advisors in the country and only 400 within the Elite Advisor program, and all four of the advisors, four advisors are in that program. So we really think that's very, very critical. You know, Bill also mentioned the what we invest as a firm, and it's really an investment into education, and we're now in upwards of $50,000 a year in spending on education, and that is not product-based. Again, that's based on strategy and what's going on, and really how to help people through all of their financial life. So, Bill, we often say when someone's looking at us, whether to work with us or they're working with an advisor, there's some important questions to ask the advisor, and one of them would be around this education piece.
Sure, I think it'd be important to ask as one of your questions when you're interviewing for your professional team, both your accounting team, your advisor, and your attorney team, is what kind of training do you do, and why do you do the training that you do, and how does it affect and help your clients? Because in our firm, we believe it's all about the advice. You can manage investments with online tools. You can read a lot of things on the internet. The internet's a great resource. But when it comes down to creating a long-term strategy that makes sense for you and your family, we think it's going to require case analysis time, so we spend time as a team leveraging all of our skill sets to come up with the best solutions based on current tax strategy for our clients that have financial situations that they need answers for. And we know during this COVID-19, a lot of people's philosophies around retirement, when that's going to be, what it's going to look like, that's changed a lot as people have spent more time at home with their loved ones and been scared by the situation that we're facing. We think going forward that people are more and more in need of professional advice that requires a good CPA advisor that's a fiduciary and a state attorney.
So Bill, you talked briefly about tools. So the education piece is obviously important, and then the second piece of this is having tools. Having the most up-to-date tools to allow us to get good information, to give good advice. And so, as a firm, we believe in those tools and investing in those tools and learning how to use those tools so that in the end, good advice comes for our clients.
Yeah, when we became an RIA 2.5 years ago, I think were surprised to learn, how many tools were available. Many advisors are, subjected to a minimum tool kit that their broker-dealer or whatever provides to them. And so, yeah, we've been able to get all of the best of the tools that give us the answers that we need to provide the solutions, complex solutions to our clients. And so it's a great point that you make, Eric, that the tools that we've been able to put in our toolkit are, I think, the finest in the industry, both from tax planning, investment planning, estate planning, and all those areas.
So we take the education and the tools, and now as I think about one situation, and we put it into a game scenario, the first half of the game, a team really works at it, plays hard, but then if they don't come back for the second half and play well, they could lose. And that could be the same in your financial situation. So we have what we call the sweet spot, which is between 59 and a half and age 72. And we think there's a lot of opportunity there. So when we return to Your Wealth Health, what we're going to talk about is we're going to talk about the sweet spot and how you should think about it. And we're actually going to show you a case and the difference, and it may surprise you as to what you see. So we'll see you real soon.
Hey everybody, this is TJ with TJ21 Media Group. As you probably know, we love creating impact in our community, whether that's through Big Brothers Big Sisters, Life Treatment Center, Hope Ministries, Real Services, Cancer Resources, whatever it may be, we love making an impact. And we want to help you create an impact in your community as well. If you purchase a sales video with us, so that's one of our mini features, it's about 2 to 5 minutes long, whatever it may be, we are going to help you help your nonprofit at no additional cost by creating a special feature on them. We love getting involved, we love making a difference, and we want to help you share your love for others as well. And maybe your nonprofit is working with Habitat for Humanity or American Cancer Society. We want to help you help them get noticed. And they can use this video for social media, for their website, for TV, whatever they want to do. Purchase a sales video from us, and we're going to choose your favorite nonprofit and do a special for them. Here at TJ21, we are passionately committed to getting everyone noticed.
Welcome back to Your Wealth Health. I'm Erik Brenner. Thanks for joining me today. And I have Bill Davis with me across the studio, and we're practicing social distancing. We want to remind you of some resources that we have here at Hilltop. You can go to our brand new website, hilltopwellsolutions.com. We have a market volatility resource center that's full of a lot of information. We have webinars that we have put on in the past, so you can sign on and see those. As well as we offer a 30-minute free meeting. It's either a phone call or a virtual meeting, just to find out more about you, your goals. You can find out more about us, and we can determine if there's a fit. There is no obligation for that meeting. We would encourage you to take advantage of that, and we can dive in a little bit to what we're talking about today. So Bill, we are in historically low tax rates. I think it's really important for people out there to realize that, this is the time. We talked about the budget deficits going up. We talked about the spending. We talked about taxes more than likely going up when you have your choice if they're going to go down, stay the same, or go up. And we are just in historically low tax rates. Now is the time to act.
Yeah, if you look at the graphic that we've prepared that compares the old tax rates to the new tax rates, Eric, one thing that really stood out to me when they passed this into law is, prior to putting this into law, you were hitting the 25% tax bracket, between 68 and 137,000 in taxable income. You don't hit 24% until 171 now, and actually can earn all the way up to 326,000 in the 24% tax bracket. So this is a huge opportunity, understanding that if they do raise taxes, you would think that they would revert back to something comparable to the 2010 tax rates. And so now would be the time, prior to either an administrative change, or even if we don't have a change in Washington, I think that whoever the ruling party is will probably be thinking about raising income to the federal government through increased income taxes, and that would not just be on corporations.
Yeah, you think about that graphic that we have on the screen, Bill. I mean, that difference of 30,000 plus from back 10 years ago, it was at the 28 bracket compared to now at the 24%. I mean, that's a big difference in those incomes. So this is marginal rates. This is not the most effective way to look at tax planning. And so we have a case that we wanted to take you through. So if you take a look at the graphic, we have a couple that is 65 and older, age 65. And what we're showing here is we're showing somebody that says, I need about $60,000 a year. That's all I need. And so if you look at on the left-hand side, we've got them coming $40,000 from their IRA and $20,000 from Social Security. Their taxable Social Security is $11,100, and then they had the $40,000 from their IRA, which gives them a total taxable income of $51,000. We mentioned earlier that depending on where you fall in your provisional income depends on how much your Social Security is taxed. Now, in the end, you'll see down at the bottom of the graphic, there's federal income taxes on this of $2,400 on Bill's $60,000 income. So someone may say, hey, I'm paying $2,400 for $60,000 of income. That feels okay to live in the great U.S. of A.
Yeah, so what we like to look at is there an opportunity to actually increase their income? And most commonly, they don't need it. What we're talking about is taking advantage of that low effective tax rate, taking out additional money out of the individual retirement account, going ahead, paying the tax on that at the low tax rate, and then deciding what a person would do with that. Again, there's multiple options. We could consider qualified charitable distributions if they don't need the money and they would like to benefit a charity. They could consider conversion to a Roth. That tends to be one of the best strategies from my perspective, is because now you've converted it to a tax-free vehicle while you're alive, if you need it, and you've also converted it to be a tax-free benefit to beneficiaries down the road. And so this illustration shows us increasing their individual retirement account distribution and paying basically the same amount of tax that they were paying on a $60,000 income. And believe me, this is very possible, and we do it all the time, where we keep your tax bill the same but increase your income.
Yeah, and I think it's important to point out on the graphic there on the screen, you see taxable Social Security. On the first scenario on the left, there's 11,100, and then on the scenario on the right, you can see it's 15,350. So if you're getting your taxes done, or you're talking just from a tax perspective, you know, someone may say to you, your preparer may say to you, well, you're paying $4,000 more taxes, or you have Social Security, you have $4,000 more that's taxable. So that you know, initially doesn't seem like, okay, should I really do this? But then it gets down to kind of that bottom line, what is the tax bill? And as Bill said, a lot of times people don't need it. But if you could take more out and do something different with it versus deferring it and then it being forced out by the time you get to age 72, and if the brackets go up. So one of the things that we think is really important from a tax perspective is it's not necessarily about your marginal tax rates. In the marginal tax rate, where someone will say, what tax bracket are you in? I'm in a 15% tax bracket, or I'm in a 22% tax bracket. But because marginal rates are, you know, kind of blocks and they go up, you could have $1 in the 22% tax bracket. And Bill, effective rates is really where we help manage people be proactive. So in this situation, the effective rate on the left-hand side, you can see is just a shade over 4%. And you may say, well, 4% is pretty good on an income of $60,000. But on the right-hand side, actually, the effective rate is 3.15. So in this scenario, Bill, someone was able to withdraw another $15,000 from their IRA and actually have a lower effective rate.
Yeah, I mean, you know, people hear the marginal rates and they say, I'm in the 22% tax bracket, but that is not what they actually pay. So that's the most important thing, is helping people understand truly what is the effective rate that you're in. Can you, is there opportunity to take withdrawals from different buckets of money that will result in a higher income at a similar or lower tax bracket? And it is possible. We do it all the time. It just takes a good team and some analysis of your tax return and your investment buckets.
So to wrap up, ultimately what you want to do is you want to know what your current effective tax rate is, and then if you make changes, what that outcome is, and compare and determine what is best for your scenario. So we are out of time for this episode of Your Wealth Health. For Bill Davis and everyone at Hilltop Wealth Solutions, thank you for joining us, and we'll see you next week.